Welcome to the SALT Sideline Report. I am Leanna Haakons, and we are here at SALT New York 2021 with David Trucano, the Managing Director of BlackRock's Opportunistic Credit Fund. Welcome, David.
Great, thanks for having me.
What were some of the key takeaways that you had on today's panel when you were talking a lot about credit markets and trends? What were the big things you took from that?
You know, it's an appreciation because I think the speakers generally were on the same page as to what the risks are and what the opportunities are across their asset classes. So I think as it relates to my business, what I heard a lot was concerns over inflation, how that's going to affect the credit markets, the opportunistic strategy, the ability to pivot across both liquid and illiquid strategies is increasingly important. Beta's no longer cheap, and I think that was the experience through 2020 for a lot of investors in the credit markets. And I think the strategies that focus on idiosyncratic or kind of more opportunistic type situations are the ones that are going to outperform over time. And I could hear that across the people that we sat on the panel with as they were thinking about how they're going to try to make money going forward.
So David, how have you seen the opportunity set evolve in the credit space throughout 2020 to this post-pandemic world now going into 2021 and 22?
Great. I feel like we're back to kind of a new normal. So I think we've gone through a period of time where we were opportunistically investing up in quality, which is something we typically don't do. So starting in the investment grade space after COVID hit, and we found ourselves trying to find opportunities across the traded credit markets. And I think over the course of 2020, what you found was the pivot down towards what we typically focus on is the more stressed, distressed end of the credit market. And I think where we find ourselves sitting here in kind of late 2021 is kind of back to our bread and butter, if you will, focusing on corporate events, focusing on companies that maybe can't access traditional forms of capital, either through credit markets, the leveraged finance market window, or the direct lending strategies that historically have focused on providing capital to the borrowers that we target. So I think we're kind of back where we were, kind of pre-pandemic from not just a spread standpoint, we're actually tighter, but from an opportunity standpoint, it actually feels more comfortable to us because it's what we do and it's what we understand.
So David, we are in a very low interest rate environment with yields at all-time lows. Where are you seeing opportunity for investors?
Sure. So in the liquid markets, it's around events. So it's companies that are trying to access capital and there's uncertainty. So what you're really doing is looking at yields on the yield to event. You're not looking at a yield to maturity or yield to call. And that's been a common theme for us as markets have gone back to what I would say are kind of historical tights. So from our perspective, that is an area where you can't use a Bloomberg to model out what you think the return is going to be. You have to have a differentiated view. Away from that, what we are focusing on are forms of new capital. So a SPAC investor market is something that's new to the corporate credit space. That's creating opportunities for us. And really in the event space, you know, activity level in corporates is at all-time highs. Mergers, acquisitions, the amount of money in private equity going after companies that historically have been issuers in the levered credit space, those present opportunities for a strategy like ours. And that's where the opportunities are in traded credit. And in the private market, the market opportunity is wide open. We are financing companies that can't access traditional forms of capital. Maybe that's because they have a business that's struggled. Maybe they have uncertain demand because COVID has not yet allowed them to figure out what their business is going to look like over the next 18 to 24 months. That's really kind of the general theme across the opportunities we're seeing across both liquid and illiquid markets.
So David, you've provided a ton of great insights on the panel today, as well as in our interview just now on the credit markets and looking forward to 2022 opportunities. What is one piece of advice that you would give to investors when they're looking at your space right now?
Sure, it's a common message that we try to send to our investors. They don't always resonate when they actually act, but the reality is don't try to time the market. We think it's a mistake from a credit perspective. You miss opportunities like the early parts of 2022 presented. We're going to be right back there again. You have to be invested in markets at all points in time in order to capitalize on a point in time. And we tell investors, don't try to time the market just like you don't in the equity markets, and just like you don't in other markets. Credit seems to be the one asset class investors think they can time and catch a period of dislocation. And I think time and time again, generally investors are left disappointed because they can't move quick enough.
Right. Time in versus timing the market.
100%.
Great. Well, thank you so much for your insights today, David. It's very appreciated.
Great. Thanks for your time.